Predicting a V-shaped economic recovery, the Central Bank of India has said that if growth momentum continues and inflation stays mild, then there will be a room for policy action to support growth. This observation came in the State of the Economy report released by the Reserve Bank of India. This comes at a time when the top banks started draining out the surplus liquidity in the money markets to stave off an economic crisis as a result of the COVID-19 pandemic. The consumer confidence is expected to increase from January 2021, peak in July 2021 and continue till September, said the report. Meanwhile, investors took some profit off the table on Friday after markets scaled historic levels a day before when the BSE Sensex surpassed the 50,000 mark for the first time. Sensex ended near the day's low at 48,878.54, down 746 points, dragged by Reliance, ICICI and the HDFC Twins. Bajaj Auto remained the best performer through the day. In this edition of The Big Picture, we will analyze the V-shaped recovery and the Sensex breaching the 50,000 mark. Joining me on the program today are Professor Charan Singh, CEO, eGrow Foundation, Nilesh Shah, Managing Director, Kotak Mahindra Asset Management Company Limited, and Jayant Das Gupta, former Secretary, Economic Advisory Council to the Prime Minister of India. Thank you to all my guests for joining me on this edition of The Big Picture. Mr. Shah, let me begin the program with you first. First, let's analyze the bull run of the Sensex breaching the 50,000 mark for the very first time on Thursday. What are the factors behind that?
So, I am reminded of an old Hindi movie song, Anhoni ko honi kar de, honi ko anhoni, ek jagah pe jama ho तीनों, Amar, Akbar, Anthony. This unhoni in stock market has happened because of flows, sentiments and fundamentals. Between FPI and retail investors in calendar year 2020, we saw $50 billion buying, highest ever. Month-on-month improving economic activity boosted sentiment, and most importantly, quarterly results which are coming are way beyond street's expectation. For the September 20 quarter, India Inc. posted its highest ever quarterly profit of 110,000 crore for Nifty 50 companies. This December quarter, so far results which have come, they are even above September quarter level. This profitability growth of India Inc. in COVID-19 environment is primarily the reason why stock markets have rebounded.
So talking about that, of course, on Friday we saw after the historic highs on Thursday that the markets closed almost 750 points lower, the following day. What could be the reason behind that? And also, can we see the Sensex or the stock markets being consistently over the 50,000 mark in the days to come?
So it's always difficult to predict short-term movement of the market. There is medical situation in rest of the world, including in China nowadays. There is budget which is on the annual on 1st of Feb. So markets will continue to move up and down. But if the quarterly profit run rate which we saw in September quarter continues, then certainly there are good days for the market.
Absolutely. Okay, talking about good days, Mr. Das Gupta, let me bring you into the picture now. The RBI also is suggesting that there are good days ahead as far as the economy is concerned, and we are likely to see a V-shaped recovery. What are the factors that are going to contribute towards this?
The first thing which comes to mind is that agriculture has done very well. The Kharif production, for instance, last year, has been about 6% more than the previous year's production. So that is a very good augury for things to come, because it affects the sentiment of the investors. The second thing is, if you take indices like the Purchasing Managers Index for manufacturing, it is higher than that of December, and it is much higher than December 2019. Similarly, for services, the Purchasing Managers Index is showing an upward trend. The third thing is that bank credit, after remaining below the 6% mark, has now gone above the 6% mark. So there is a demand for bank credit. The next point is that the consumer sentiments, which have also been, there is an index for that, that is showing an uptick. And if you remember, the private final consumption expenditure in India accounts for more than 60% of the GDP. So that is, again, a very good sign. And the final thing is that the government's expenditure, especially the capital expenditure and the transfers to the states for capital expenditure, that has gone up. Similarly, the offtake of the MNREGA scheme, that has also been very good, and that is putting money in the pockets of people who are going to spend more. In fact, if the recent reports are to be seen, about 130% of the original budgeted amount has already been spent on MNREGA. The last point is that if you just track the unemployment figures from the beginning of January 2021, we will find that from 9%, it has now come down to about 7%, 7.2% in the rural areas and 7.7% in the urban areas. So unemployment is showing that it is coming down. So more and more people are getting employed. So that will mean that money is circulating. People are having greater capacity to spend. So all these things point towards the fact that perhaps in the last quarter of the financial year, we will actually see a much better performance than in the previous quarter. Previous quarter itself, the third quarter, we were perhaps 0.1% on the positive side. And in this quarter, it could be much better. So the RBI's projection of 7.5% decline in the GDP could be overhauled, and we may come out with a lesser, smaller declining figure.
Absolutely. All right. So, Professor, let me bring you in now. The RBI in its State of the Economy report also talks about how there could possibly be room for policy action to support growth. So what kind of policy action can we expect?
First of all, I must mention that the State of the Economy is a very good write-up that they have given. And as my predecessor on the panel was saying, the factors that they have given are also very good. The economy is looking up. Now, if you look up that State of the Economy report in the bulletin, they do mention that the transmission of the repo interest rate has not been effectively taking place. And they have given the comparisons very well. So if you look at the comparison from March to the latest data, you find that the Reserve Bank reduced the repo rate by 150 basis points, 115 basis points, but no, the lending rates have not come down effectively. They have given a chart and they show that some of the lending rates have come down by just 67 basis points, and the largest that has come down by 94 basis points if you take different categories into account. So I think the first thing that they would probably be considering is that they would either make it more effective, that the lending rate should be brought down, or they will probably reduce the repo rate further. I am myself of the view that the repo rate can be reduced further, because if you look at inflation, the inflation figures, and again given in the same report, inflation figures were generally high mainly because of food. Food inflation has been partly taken care of now, and it is subdued. So therefore, there is chance and there is a possibility that we could go in for further reduction and the repo rate. Now, February 5 is the next policy. February 1 is the budget. So depending on what the budget says, the Reserve Bank could consider that. On the liquidity, my own experience, and of course given in the report, has also been that the Reserve Bank has very well handled the liquidity part, especially the targeted long-term repo rates that they have handled. That repo has come out very well. So liquidity part is taken care, and I'm sure they'll continue to take care of that part. The other is the Reserve Bank has been very accommodative to the commercial banks and to the industry in terms of moratorium. So maybe the Reserve Bank is thinking, maybe if it is supported by evidence, extending that accommodative policy for commercial banks and credit to these sectors.
Right. All right. So, Mr. Shah, let me come back to you once again now. As far as investors are concerned, are they also seeing the same picture of this V-shaped recovery? And, are they expecting more of that in the next quarter?
Undoubtedly, investors are looking towards future with bullishness, apart from many factors which have been mentioned before. There is one big factor which investors are betting upon. If you look at gross capital formation of India, it fell from 34% in 2012 to 28% in 2020. This drop in gross capital formation was essentially driven by household, which is essentially you and me investing in real estate. It fell from 16% to 11%, down by about 5%, accounting for 83% drop in gross capital formation. And now stars are aligned for revival of real estate. Number one, affordability has increased. The affordability index of housing, which was around 50% in 2012, is now about 27%. Housing interest loans is available at 6.75%. With RERA, house buyer is protected. And more importantly, in this work from home environment, everyone is running one short room in their houses. So the demand is there, supply could be increased, affordability has increased, interest rates are low, and on top of it, many state governments are giving stamp duty concession. So investors are looking towards the future with positivity. There are many factors which could sustain this V-shaped recovery. However, obviously, investors will keep an eye on medical situation. Fortunately, with the grace of God, in India, things are under control. But if you look outside, be it UK, US, China, things seems to be deteriorating on COVID-19.
Mr. Shah, talking about this medical situation, a quick follow-up question there. The fact that India has done reasonably well, has done very well really in dealing with the pandemic at large, is that something that the foreign investors are looking at too, as far as India is concerned?
So in a very lighter way, I can say that the world is seeing two largest countries in a completely different color. One probably gave Wuhan virus to the world. At least they have been fairly non-transparent in handling of virus. On the other hand, India is providing vaccines to the world. Undoubtedly, India is being appreciated by foreign investors. But at the end of the day, in a serious manner, investors will invest in India as long as we provide growth opportunity, which is better than our peers. So while our perceptions will be good with the way we have managed COVID-19, we can't take away the responsibility of providing growth opportunity to investors.
Absolutely.
World is full of liquidity and negative to zero interest rates. They'll be happy to give money as long as we provide growth opportunity.
So, Mr. Dasgupta, let me come to you now. As far as the recovery is concerned, what are the sectors that we need to watch out for, and how do we continue to give this growth opportunity that Mr. Shah is talking about?
The areas which will show growth now would be e-commerce and digital technologies in its various facets. But there are areas which have been hit very badly and disproportionately at that, which includes the hospitality sector, tourism, entertainment, and a few other things. Now, these are the areas which will face a very difficult time, because many of them, will turn into NPAs as well. Despite the moratorium, once it is over, they will face a huge problem. So the government needs to, and mind you, these sectors are one of the largest employers taken together. Tourism, hospitality, the business, restaurants, which are standalone restaurants, all put together. So we will have to be mindful of that, and the government will need to come out with sectoral policies to ease out the pain for those sectors which have a large number of people employed in them, and which contribute substantially to the GDP and which are in trouble. So that will be one of the